Hello, everyone. Welcome back to FX Limit, where we dive into the depths of Forex trading and unravel the secrets of technical analysis. Today, we're going to explore an incredibly useful tool in the trader's arsenal, the Commodity Channel Index, or CCI. This tool is a game changer for identifying overbought and oversold conditions in the market, and I'm excited to guide you through how to use it effectively. So, what exactly is the Commodity Channel Index? In simple terms, the CCI is a technical indicator used to spot potential reversals in the Forex market. It measures the current price level relative to an average price level over a specified period. The CCI fluctuates above and below zero, and it's this movement that traders keenly watch. But how does this help in identifying overbought and oversold conditions? Well, when the CCI rises above plus 100, it signifies that the price is well above the average, indicating overbought conditions. This could be a signal for a potential price reversal or pullback. On the flip side, when the CCI falls below minus 100, it suggests that the price is significantly below the average, indicating oversold conditions. Again, this could signal a potential upward correction. Now, let's talk strategy. How can you, as a trader, apply the CCI to your Forex trading? The first step is to incorporate the CCI into your trading platform. Most platforms have this indicator, and it's usually straightforward to add it to your chart. Once you've got the CCI displayed, it's all about interpretation. One effective method is to look for divergence between the CCI and the price action. For instance, if the price is making new highs but the CCI is failing to surpass its previous highs, this divergence could indicate weakening upward momentum, hinting at a possible bearish reversal. Another approach is to use the CCI in conjunction with other indicators. Pairing the CCI with, say, moving averages or support and resistance levels, can provide more robust trading signals. For example, if the CCI indicates an overbought condition and the price is at a significant resistance level, this could strengthen the case for a potential sell. But remember, no indicator is foolproof. It's crucial to consider the overall market context and not rely solely on the CCI. Also, be aware of false signals. Sometimes, the CCI might indicate an overbought or oversold condition, but the price may continue to trend. That's why combining the CCI with other analysis tools and techniques is a wise strategy. Let's not forget about risk management. Even with the best tools and strategies, Forex trading involves risk. Always use stop-loss orders to protect your trades and manage your risk effectively. It's better to be safe than sorry, especially in the fast-paced world of Forex trading. In conclusion, the Commodity Channel Index is a versatile and valuable tool in Forex trading. It helps traders identify potential reversals by highlighting overbought and oversold conditions. However, it's important to use the CCI wisely, in combination with other tools, and within the context of a well-thought-out trading plan. That's all for today's session at FX Limit. I hope this insight into using the CCI in Forex trading has been enlightening and will help you in your trading journey. Remember, trading is both an art and a science. Keep learning, keep practicing, and most importantly, keep a level head. Thanks for tuning in, and I'll see you in the next video where we'll delve into another fascinating aspect of Forex trading. Until then, happy trading.